Hello and welcome to Investors Guide. Thanks for joining us this week. We have a packed show lined up for you today. We're going to answer some questions, plan some portfolios, and of course help you get rich. Now, speaking of getting rich, remember you can write to us. There's an email ID at the bottom of your screen. You can send in details about your portfolios and your investments, and we can tell you if your portfolio is on track. Let's get straight to it. This is what we're doing over the next half hour. We'll build a mutual fund portfolio for a 36-year-old who has put a lot of his money in fixed deposits. We'll find out if that's a good idea. Also, find out if you should include an international fund in your portfolio. And we'll continue answering your questions on insurance with our expert. That's later on the show. All right, let me first introduce Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert. Dhirendra, thanks so much for joining us on this show. Let's get straight to our portfolio versus portfolio questions. Well, Vedanta has written in this week. He tells us he's 36 years old and he works for a foreign bank. Now, he has savings of about 80,000 rupees every month for investing after meeting his personal investment expenses. Now, he tells us his current savings stand at 43 lakh rupees, all of which are in a fixed deposit. That's giving him an average of 9 to 11% every year. He has 2 lakh rupees invested in mutual funds, and he's invested them in HDFC Top 200, DSP BlackRock Equity, and HDFC Equity Fund. Now, he lives in a home with his parents that he owns, so he doesn't have to spend any money on rent. He wants to know if he should invest his savings now in mutual funds or buy property instead in Mumbai that he can give out on rent. We're going to approach this piece by piece. First of all, 43 lakh rupees in a fixed deposit for a 36-year-old. Does it make sense?
Yes, it is too much money in debt, but not really if he is contemplating buying a house, because which means that this is basically parked and yielding very high return while he's about to spend that money in acquiring the assets. So in that sense, maybe not. If he is close to taking that decision, it's all right to be in fixed for a banker to have the fixed deposit, because he can liquidate these without much of a without any serious penalty and at short notice. But yes, if it was an investment portfolio, then it is, I think, a very unwise way of approaching it for a 36-year-old who has all the time on his side. A good part of his money should ideally be in equity.
We're just going to go over the funds that he's invested in. He only has 3 funds. There are only 2 lakh rupees invested in these funds. HDFC Top 200, DSP BlackRock Equity, and HDFC Equity. Now, these are funds that we recommend on the show. But do you think these 3 funds together would cover him for a portfolio, or should he be re-looking at these investments?
Yeah, the 3 portfolios, the 3 funds are good funds. But I think this is virtually nothing. This is the way it has been approached. I don't think he look at it as a portfolio. These are just 3 random investments. This is 5% of his total investment, not even that. So from that standpoint, it's not a portfolio. It's just 3 funds picked at some point for some reason.
But this is the big question, really, from his portfolio. Should he buy a home in Mumbai? And this is his second home, so this is not a home to live in. This is a home he will buy as an investment. Or should he invest his money in equity? And this is a question that a lot of viewers would have. Does it make more sense if I can afford it to buy real estate? Or should I be investing my money in equity? How would you recommend that he tackle this question?
If he's looking at a second home, which he can let out and seek rental income, it may not be a great idea, because and it's also a function of there are many variables. Your ability to manage that property, the ticket size, the lack of liquidity, and possibly a timing risk. You might it may be a great time, it may not, or it may be a bad time, depending on when you take a stock of this. Think of the effort it will take to get first getting that property in shape, following it up, making sure it happens, and then getting a tenant and keeping track of that. The third could be that never buy a problem and invest a large sum to buy a problem, from a standpoint that if it is going to stress your cash flows at any point, and the EMI could be quite sizable on this. So I think I I think he should get answer to these questions himself to arrive at a decision.
Alright, go over those questions that you just heard to arrive at your decision. There one last question about this portfolio. When you look at his mutual fund investments, 2 lakh rupees, would you recommend he switches to one of our portfolios to probably get a more comprehensive look at his equity investment?
I would urge him to look at our growth portfolio or aggressive portfolio, or to begin with, in a very conservative way, look at our stable growth portfolio and be on some investment plan where he's investing at defined periodicity and keeping track of it.
Right, that's the advice going out to you. Our aggressive portfolio, they're flashing on your screen. These are the funds that we have invested in. You can jot that down, and someone from our team will also send you this list of funds so that you can have a copy with you. Let's move on now to our hold or sell segment. Roshan has written in this week. He's 45 years old and he's been investing 24,000 rupees in 8 different mutual funds every month for the past 18 months. He tells us he has a 10-year horizon and he wants to increase his monthly investment by another 3,000 rupees. He's also interested in investing money in gold and silver. So he sent us a list of his funds and he wants you to take a look at it and tell him which of these funds he should continue investing in, which he should redeem out of, and if his portfolio is on track. So the first one on his list is the DSP BlackRock Top 100. Hold or sell, Zain?
This is a hold, an excellent large cap fund.
The ICICI Prudential Focused Blue Chip Fund is the next one on this list. Hold or sell this one?
Oh, this is a hold. It's a relatively new fund, but an outstanding fund so far.
The HDFC Top 200 Fund is the next one on the list. Obviously, hang on to this one as well.
Yeah, hang on to this one as well. A good large and mid cap fund.
He seems to like the equity diversified funds. The Birla Sun Life Frontline Equity, another one that we recommend on the show. It's the next one on the list. 3,000 rupees going into that fund every month. Continue that investment, right?
Yeah, absolutely. This is another good fund which he has.
His portfolio is starting to look very strong. HDFC Equity Fund is the next one on the list. Hang on to it?
Yes, hang on to this one as well. We keep recommending in as part of our few portfolios.
Well, Roshan is obviously someone who watches this show very closely. The Reliance Regular Savings Equity Fund, 4,500 rupees investing in this fund. Obviously, continue that investment as well, right?
Yeah, this is again a good fund from Reliance, and should continue investing in this one as well.
The DSP BlackRock Equity Fund is the next one on the list. This is fund number 7 and they are all equity diversified funds. Does he run the risk of duplication in any way, or should he continue investing in this one as well?
Should continue investing, and there could be little complementarity. HDFC Top 200 and HDFC Equity, there could be an overlap. Likewise, DSP Top 100 and DSP BlackRock Equity, there will be an overlap. If he's working hard to reduce some of those, I would say that he can do without having the top 200 or top 100. But having those does not hurt the performance. On a standalone basis, they are a reasonable choice. And I would say that it's entirely up to him. If he just wants to reduce the number of funds he has. Otherwise, he can continue on his plan.
The last fund on his list is the IDFC Premier Equity Plan. There's 3,000 rupees going into that fund as well. Obviously, continue that investment.
Must continue this one, and I don't think there is any overlap or anything.
It's obviously a very strong portfolio when we look at it, but he has two main questions. One, he wants to increase his investment by 3,000 rupees every month. So, which of these funds should he be increasing that investment into? And of course, he wants to start investing in gold and silver. So, is there any way you can recommend that he can include gold and silver in his portfolio?
Entirely his call. I think gold is a speculative investment and it's doing very well right now, and it should generally not exceed 5-7% of his total holdings. As far as increasing, investing more, I think he should just try and increase his investment allocation to all these funds proportionately, or one or two funds. Given his age, I would rather increase his investment in IDFC Premier Equity and HDFC Equity and DSP BlackRock Equity, where his exposure to the relative allocation to mid and small cap will be higher, and he has time on his side.
All right, Roshan, that's the advice going out to you. Good luck with those investments. Your portfolio seems on track. Right back to us if you have any more questions about your investments. Jayendra Kumar is going to stay with us on the other side of this break. We're going to talk about international funds and whether you should be investing in it. So don't go anywhere. us. You're watching Investors Guide on ET Now, and Virendra is still with us in Delhi. And like we promised in the previous segment, we know that there are international funds in the market that have been getting a lot of attention because they've beaten the Sensex and the Nifty over the last year, giving returns of about 17 to 17.9%. Now, we're all curious to know whether we should be investing in these international funds and adding them to our portfolio to maybe get a little bit of extra push when the Indian markets are down. But for that, we first need to understand how these international funds work. So we put together a quick package for those of you who don't know how an international fund works. Take a look and then come back and we'll talk about it. In a world where your clothes, shoes, food and drink are global brands, does it make sense for your investments to be bound by national borders? That's the argument that brought about international funds. Funds that predominantly invest in equity securities listed overseas.
You might have kind of emerging markets fund which will focus only into the emerging market equities. Of course, there could be thematics, which could invest into the energy or infrastructure sector. So essentially, you're offering investors a diversification, out of India into global equities.
International funds function like fund of funds. So if you invest in a fund in India, the Indian Asset Management Company will invest your money in a global fund that's managed overseas.
The expertise that is not available in India. Because the international equity market is such a large investable universe, the expertise resides outside India with asset managers like BlackRock or any other international asset managers. And what we do in India is we seek investments from our investors. The investments are then made into international funds which are managed by BlackRock's team sitting out of London.
The important thing to keep in mind while investing in pure global funds is the tax rate. Because they don't have 65% or more invested in domestic equities, the returns are subject to both long-term and short-term capital gains tax, which means you don't get the tax benefit. Obviously, international funds are getting a lot of attention because, international markets outperformed the Indian stock market over the last 4 or 5 months. But would you recommend that investors include an international fund in their portfolios? Do you think that's a good idea?
Principally, yes. But looking at, past 10 years, the performance of Indian market has been such, and Indian markets have outperformed most other markets. So the home bias is understandable. At the same time, this diversification may not necessarily always work. What we have seen is that the direction of all markets could be the same. The magnitude can change. So I would say that international diversification, principally, the very reason why we keep saying that, diversify, buy a mutual fund and be into mainstream things, that's a very logic, that's a very rational why one should have international funds. And from that standpoint, I think, one should, but I think there is a dearth of options. We have very few funds which will help you achieve this goal with simplicity.
The other thing to consider, obviously, when investing in an international fund is the risk, because the risk is not exactly the same as investing in an Indian equity fund. How, as a retail investor, how should I assess the risk of an international fund that's going to be putting my money somewhere overseas?
That the risk is fairly straightforward, that you will be exposed to added dimension, which is in an investment, which is your money is actually invested in some other market, and if rupee strengthens or weakens, then it will have an impact on your investment. So that is an added dimension when you are investing abroad, whether directly or through fund. In case of funds, you really don't have to do anything about it because it will have an impact on your investment. But when you write a check or when you get your redemption proceeds, you get it in rupee terms. You get it in your bank account in rupee. So in that sense, you don't have to do much about it. You don't have to worry about the mechanics, but it has an impact on your investment. Then comes which fund to choose. I think there we have too many options, but most of them are fairly undesirable way. You have undesirable options. They don't help you achieve the goal of in spreading your money globally. You have exotic schemes, something which is World Energy Fund, World Gold Fund. You have the Latin America Real Estate Fund. So these are stories which are worth avoiding. At the same, the other set of alternatives you have is specific geography. You have the Nasdaq fund, Nasdaq ETF, which is available now, or you have the China fund which is available, or a Korea fund which is in the pipeline. So that's another one. Then you have the emerging market, of which India will be a part of it, so that is not truly a diversification.
Since we have a few global equity funds that we should have in our portfolios, it makes sense. Are there any that you can recommend to our viewers, maybe one or two that they can consider instead of being lost in that whole sea of exotic funds that are available?
I would suggest that the funds which can invest up to 35% globally, they should be the first option for investors. And from that standpoint, Fidelity International Opportunity and Templeton India Equity Income Fund, these are two options which can invest up to 35%. The tax treatment and all the benefits of an Indian equity fund is available to these funds as well.
Alright, so that's the advice going out on investing in international funds. Remember, it makes more sense to invest in an Indian fund that allows about 30-35% of its portfolio invested overseas than to buy an exotic sounding international fund, because there's a lot of risk that you will be taking up if you buy into one of those funds. We're moving on to our big fund review. We're looking at the Morgan Stanley Growth Fund, and Avan is here like always to tell us a little more about that fund. Avan.
The big fund in focus today comes from a global financial services fund, Morgan Stanley. Launched in 1994, Morgan Stanley Growth Fund was a 16-year-old closed-ended scheme. It was converted into an open-ended scheme in the year 2009. The fund has given its investors an annualized return of 13% since its inception. The year 2008 was very harsh on all equity diversified funds, and closed-ended funds were no exception. What's worth noting is that over the years, the fund has been able to curtail its falls as compared to its peers. Let's bring in some numbers to get you a better perspective on the fund's performance over the years. So if you invested 1,000 rupees in this fund when it launched, you would have 6,294 rupees today. But is this fund a good buy? Our experts are here to tell you exactly that.
Thanks, Avan. The Morgan Stanley Growth Fund, above average risk, below average return, not something you like recommending on the show, is it?
Yes, it is avoidable, and this is one part of it. The other is that it has sustained a similar character over a very long period of time. It was among the first few funds to get started after the mutual fund sector was opened up for private participation. So started in 1984, and it has a long history of doing exactly what it has done. It is not a disappointing fund. If you look at the absolute return, a 20% annualized return over the past 10 years, I don't think it is a small return. But compared to other options which investors have, I think this fund has always been little below average.
So fund was always a little below average. It does have net assets of 1,600 crore rupees. And it's been around for 15 years. So there might be investors still involved in this fund who've been around for 15 years themselves. What would you recommend that these investors do right now? Should they be looking for better options in the market, redeeming their money?
Yes, I think they should be looking at better options. I think Morgan Stanley itself offers another fund, which is Morgan Stanley ACE Fund, which could be a superior choice. And I think this fund has not. I don't know what it does. We have not been able to pin down on anything specific. But because the portfolio looks good, portfolio looks fairly well poised, but it always does little worse than the average.
Finally, your star rating on the Morgan Stanley Growth Fund. Should investors consider this at all?
No, it is an avoidable fund. I will, and on a risk-adjusted basis, it gets a 2-star, and that is what it will be.
2 stars there for the Morgan Stanley Growth Fund. Remember, they're saying that it's a below-average fund, so it's amply avoidable because there are better options out there for you. Dhiren, thanks so much for joining us and answering our questions. Remember, if you have questions for Dhiren, you can write into us. There's an email ID at the bottom of your screen, or you can get in touch with us through Facebook as well and find any of the information that you heard on the show today. Slipping into a quick break. On the other side, we're answering questions on insurance. So stay with us. back. You're watching Investors Guide. We have our special insurance expert joining us as he has been doing over the last couple of weeks. Anil Sehgal of iSave is the expert who tracks insurance very closely. Joins us one more time to answer some questions. Now, Anil, the first question comes in from Rohit, who says he's 30 years old and he bought a Mediclaim floater policy for 5 lakh rupees for his family. Now, he currently has a 10% no claim bonus for the last year. And he tells us on his policy that the bonus can go up to 50%, which means that his sum assured would go up to 7.5 lakh rupees. Now, he's worried because he thinks that the cost of hospitalization over the next 10 or 15 years might be much higher than his sum assured. So 7.5 lakh rupees won't be enough. And most of the policies in the market only give you covers of up to 10 lakh rupees. So what should he do now? Should he buy 2 health insurance policies for his family? How should he try and increase that cover to be prepared?
Rohit, you mentioned that you already have a Mediclaim policy for about 5 lakhs, which given the no claim bonuses which will get added on over a 5-year term, could go up to 7.5 lakhs sum assured, and you want to take additional cover beyond this. Now you have 2 options for this. You could take an individual cover, which is a supplemental cover, which you can kind of use if and when the family floater cover that you have already got is exhausted. These tend to be cheaper plans as well because they are essentially in the nature of a high deductible and would only pay once the initial claim has been paid under your existing policy. So for this kind of plan, you could consider Bharti AXA's high deductible cover, and this could be one option for you. The other option, of course, is that if you want to continue with a family floater plan which has a higher sum assured, most plans are between the limit of 7.5 lakhs to 10 lakhs. So if you want to cover more than 10 lakhs, you could consider Max Bupa's Family First or Heartbeat Platinum. Now in both these cases, in Heartbeat Platinum, you can go up to a sum assured of 15 lakhs. And in the case of 35 lakhs, I'm sorry. And in case of Max Bupa, you can go up to an individual cover of 5 lakhs and a health family floater of 15 lakhs on top of that. So you have multiple options in that case, and you can look at both of these things. Now in the event that you're looking at switching from your existing policy to a new policy, I would suggest that you kind of wait till the 1st of July when the portability for health insurance products will kick in. And once that happens, you can kind of carry forward into your new policy your existing no claim bonuses, as well as the number of years that your policy might have been in existence already, which will kick in and contribute towards any waiting periods which might be there. So I think if you are looking at switching to a higher sum assured policy, you should look at doing that post July 1.
Alright, our next question comes in from Novi, who writes in to say that he's been watching Investors Guide regularly and he heard us talking about the fact that you can get a term cover of about 1 crore rupees for as low as 10,000 rupees a year. Now he tells us he's 44 years old and he wants to buy that additional cover apart from the insurance policies that he already has. So Novi, you know that your premium depends on the age and of course the cover that you buy. But let's ask Anil what sort of rates you might get in the market. Anil, do you think he'll be able to get a policy for 10,000 rupees?
Novi, certainly you should be looking at a 20-year term or so if you're looking at additional covers to top up whatever life insurances you already have. Now, you're right that online term insurance typically costs less. In your case, however, if you are 44 years of age and you're taking a 20-year term, 1 crore policy would typically cost you between 26,000 to 33,000 depending on which insurer you choose to go with. For you, the cheapest plans would be ICICI Prudential's iProtect or MetLife's MetProtect or Aegon Relegare's iTerm, as well as Kotak ePreferred. So these are 4 plans that you could consider, but the premiums would typically be between 26,000 to 33,000 for your age and for 20-year terms for 1 crore sum assured.
Anil, thank you so much for joining us on the show and answering those questions on insurance. Remember, if you have questions about your insurance policies, you can write to us on the email ID that's at the bottom of your screen, or you can find us on Facebook and send us your questions as well. Thanks for watching Investors Guide this week. Remember, send in your questions with as many details as possible. Tune in next week to catch Investors Guide.